the income statement, statement of retained earnings, and the balance sheet. This segment's learning objective is to explain how the income statement and the statement of retained earnings relate to the balance sheet. An income statement shows the revenue and expenses of a business for a specified accounting period. In the statement of retained earnings, the net income figure from the income statement is added to the beginning retained earnings balance, while dividends declared during the period are subtracted, and arriving at the ending retained earnings balance. The ending retained earnings balance is then reported in the balance sheet as a component of owner's equity. The income statement is prepared first because it determines the amount of net income to be reported in the statement of retained earnings. The statement of retained earnings is prepared second because it determines the amount of retained earnings to be reported in the balance sheet. Alternative titles for the income statement include earnings statement, statement of operations, and profit and loss statement. However, income statement is the most popular term for this important financial statement. The income statement is used to summarize the operating results of a business by matching the revenue earned during a given period with the expenses incurred in generating that revenue. The revenue and expenses shown in Overnight's income statement are taken directly from the company's adjusted trial balance. Overnight's 2018 income statement shows that revenue exceeded expenses for the year, thus producing a net income of $39,942. Bear in mind, however, that this measurement of net income is not accurate or precise due to the assumptions and estimates in the accounting process. An income statement has certain limitations. For instance, the amounts shown for depreciation expense are based upon estimates of the useful lives of the company's building and equipment. Also, the income statement includes only those events that have been evidenced by actual business transactions. Perhaps during the year, Overnight's advertising has caught the attention of many potential customers. A good customer base is certainly an important step toward profitable operations. However, the development of a customer base is not reflected in the income statement because its value cannot be measured objectively until actual transactions take place. Despite these limitations, the income statement is of vital importance to the users of a company's financial statements. Here is the income statement of Overnight Auto Service for the year ended December 31, 2018. Retained earnings is that portion of stockholders' or owners' equity created by earning net income and retaining the related resources in the business. The resources retained from being profitable may include, but are certainly not limited to, cash. The statement of retained earnings summarizes the increases and decreases in retained earnings resulting from business operations during the period. Increases in retained earnings result from earning net income, decreases result from net losses and from the declaration of dividends. Here is the statement of retained earnings for Overnight Auto Service for the year ended December 31, 2018. The amount of retained earnings at the beginning of the period is shown at the top of the statement. Next, the net income for the period is added, or net loss subtracted, and any dividends declared during the period are deducted. This short computation determines the amount of retained earnings at the end of the accounting period. The ending retained earnings, $25,942 in our example, appears at the bottom of the statement and in the company's year-end balance sheet. The statement of retained earnings for Overnight is unusual in that the beginning balance of retained earnings at the date of the company's formation, January 20, 2018, was $0. This occurred only because 2018 was the first year of Overnight's business operations. The ending retained earnings, $25,942, becomes the beginning retained earnings for the following year. In Session 3, the declaration and payment of a cash dividend were treated as a single event recorded by one journal entry. A small corporation with only a few stockholders may choose to declare and pay a dividend on the same day. In large corporations, an interval of a month or more will separate the date of declaration from the later date of payment. A liability account, dividends payable, comes into existence when the dividend is declared and is discharged when the dividend is paid. Because Overnight reports no dividends payable in its adjusted trial balance, we may assume that it declared and paid the entire $14,000 on December 31, 2018. Finally, it is important to realize that dividends paid to stockholders are not reported in the income statement as an expense. In short, dividends represent a decision by a corporation to distribute a portion of its income to stockholders. Thus, the amount of the dividend is not included in the computation of income. The balance sheet lists the amounts of the company's assets, liabilities, and owner's equity at the end of the accounting period. The balances of Overnight's asset and liability accounts are taken directly from the adjusted trial balance. The amount of retained earnings at the end of the period, $25,942, was determined in the statement of retained earnings. Balance sheets can be presented with asset accounts appearing on the left and liabilities and owner's equity accounts appearing on the right. They may also be presented in report form. with liabilities and owner's equity listed below rather than to the right of the asset section. It is also common for corporations to refer to owner's equity as stockholders' equity. Here is the balance sheet for Overnight Auto Service for the year ended December 31st, 2018. Many companies group together as separate balance sheet subtotals those assets and liabilities that are considered current. This is referred to as preparing a classified balance sheet. To be classified as a current asset, an asset must already be cash or must be capable of being converted into cash within a relatively short period of time. For most companies, this period is usually 1 year or less. Those assets that get used up quickly, for example, insurance policies and office supplies, are also classified as current assets. Of Overnight's $126,192 in total assets, the current assets include cash, accounts receivable, shop supplies, and unexpired insurance. Thus, $30,042 of Overnight's total assets is considered current. A current liability is an existing debt or obligation that a company expects to satisfy relatively soon using its current assets. Once again, this period is typically 1 year or less. While not a debt, unearned revenue is often considered a current liability also. All of Overnight's $20,250 in total liabilities shown are considered current liabilities. Computing separate subtotals for current assets and current liabilities is very useful when evaluating a company's ability to pay its debts as they come due.